Good morning and namaskar. This is the first monetary policy statement of the current financial year 2022-23. I welcome everyone to this statement, which will be followed subsequently at 12 o'clock by the usual press conference. 2 years ago in March 2020, we began a journey to fight the onslaught of COVID-19 on our economy with courage and determination. During the period thereafter, the Reserve Bank has successfully navigated its course through turbulent waters. While the pandemic has scarred our psyche and tested our resilience, we have responded with bold, unconventional, and resolute measures to stabilize the economy through the 3 waves of the pandemic. As the situation normalized, we have taken measures towards rebalancing liquidity conditions while ensuring that our actions are nimble and proactive but well-timed. Now, 2 years later, as we were emerging out of the pandemic situation, the global economy has seen tectonic shifts beginning 24th February, with commencement of the war in Europe, followed by sanctions and escalating geopolitical tensions. We are confronted with new but humongous challenges: shortages in key commodities, fractures in international financial architecture, and fears of deglobalization. Extreme volatility characterizes commodity and financial markets. While the pandemic quickly morphed from a health crisis to one of life and livelihood, the conflict in Europe has the potential to derail the global economy. Caught in the cross-current of multiple headwinds, our approach needs to be cautious but proactive in mitigating the adverse impact on India's growth, inflation, and financial conditions. We are, however, reassured by the strong buffers that we have built over the past few years, including large foreign exchange reserves, significant improvement in external indicators, and substantial strengthening of the financial sector, all of which would help us to weather this storm. Please note that I'm emphasizing on 3 different aspects which places us in a position that would enable us to deal with the emerging crisis and the challenges. The first, significant improvement in the external sector. The second, foreign exchange reserves, which are at very comfortable levels. And third, substantial strengthening of the financial sector. I will be dwelling upon this in detail in the later part of my statement. Once again, we in the Reserve Bank stand resolute and in readiness to defend the economy and navigate out of the current storm. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. Against this backdrop, the Monetary Policy Committee, that is MPC, met on 6th, 7th, and 8th April, and based on an assessment of the macroeconomic situation and the outlook, voted unanimously to keep the policy repo rate unchanged at 4%. The MPC also decided unanimously to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.25%. Further, it has been decided by the Reserve Bank to restore the width of the liquidity adjustment facilities, that is the LAF, that is the LAF corridor, to 50 basis points, 50 to 50 basis points, the position that prevailed before the pandemic. The floor of the corridor will now be provided by the newly instituted Standing Deposit Facility, SDF, which will be placed 25 basis points below the repo rate, that is at 3.75%. I shall explain the details in this regard in the later part of my statement. Let me first dwell upon the MPC's rationale for its decision on the policy rate and the stance. Since the MPC's last meeting in early February 2022, the expected positive benefits from the ebbing of the Omicron wave have significantly changed. Omicron wave have been offset by the sharp escalation in geopolitical tensions. Let me just read this sentence again. Since the MPC's last meeting in February 2022, the expected positive effects of the Omicron wave, expected positive benefits from the ebbing of the Omicron wave have been offset by sharp escalation in geopolitical tensions. This has significantly changed the external and domestic landscape. Concerns over protracted supply disruptions have rattled global commodity and financial markets. Given the significant share of the two economies engaged in the war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible oil and fertilizers. Now these are, I have listed out the points which basically are at the root of the concerns over the protracted supply disruptions which are causing all these turbulence and in all these areas. So concerns over protracted supply disruptions have rattled commodity and financial markets. Given the significant share of the two economies engaged in war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible oil and fertilizers. I repeated this sentence so that there is clarity in, there is clarity in our communication. Global crude oil prices briefly crossed $130 per barrel, touching their highest level since 2008, and remain volatile at elevated levels despite some recent correction. Global food prices, along with metal and other commodity prices, have also hardened significantly. Risk aversion towards assets of emerging market economies has increased, leading to large capital outflows and depreciating bias in their currencies, that is, currencies of the emerging market economies. These developments have first ratcheted up the projections of global inflation, which was already running well above the target in the major countries, and second, will produce sizable adverse impact on output across geographies. The geopolitical tensions have exacerbated at a time when the global economy was grappling with a sharp rise in inflation and consequent monetary policy normalization in major advanced economies. Global supply chain disruptions and input cost pressures are now expected to linger even longer. The resurgence of COVID-19 infections in some major economies in March and the associated lockdowns run the risk of further aggravating the global supply bottlenecks and input cost pressures. World trade and output and hence external demand are likely to be weaker than envisaged 2 months back. Overall, the external developments during the past 2 months have led to materialization of downside risks to domestic growth and upside risks to inflation, and upside risks to the inflation projections that was made during the MPC meeting of February this year. Inflation is now projected to be higher and growth lower than the assessment during February. Economic activity, although recovering, is barely above its pre-pandemic level. Against this backdrop, the MPC decided to retain the repo rate at 4%. It also decided to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. I would now like to provide our assessment of growth and inflation. And first, I would take up growth. According to the second advance estimates released by the National Statistics Office, NSO, on February 28, real GDP rose by 8.9% in 21-22. Private consumption and fixed investment, key drivers of the domestic demand, however, remain subdued, with these two components being only 1.2% and 2% respectively above their pre-pandemic levels. On the supply side, contact-intensive services still trail the 2019-20 level. Nevertheless, the Indian economy is steadily reviving from its pandemic-induced contraction. During 21-22, weaknesses in economic activity resurfaced in third quarter and got exacerbated by emergence of the Omicron variant in January 2022. A gradual turnaround has been noticed during February, although in March a mixed picture was seen. Some contact-intensive activities have regained traction amidst declining infections and removal of restrictions. Several high-frequency indicators, namely railway freight, GST collections, toll collections, electricity demand, fuel consumption, and imports of capital goods, posted robust year-on-year expansion during the months of February and March. With the easing of restrictions, domestic air passenger traffic rebounded in the month of March. According to our surveys, consumer confidence is improving and households' optimism in outlook for the year ahead has strengthened with an uptick in sentiments. Business confidence is in optimistic territory and supportive of revival in economic activity. On the other hand, passenger vehicle sales and registrations continue to contract, although at a moderating pace. Both manufacturing and services PMIs remain in the zone of expansion. While manufacturing PMI moderated slightly in March, services and composite PMI showed improvement. Going forward, robust Rabi output should support recovery in rural demand, while a pickup in contact-intensive services should help in further strengthening urban demand. Investment activity may gain traction with improving business confidence, pickup in bank credit, continuing support from government capex, and congenial financial conditions. Capacity utilization in the manufacturing sector recovered further to 72.4%, that is 72.4% in third quarter 21-22 from 68.3% in the previous quarter, surpassing the pre-pandemic level of 69.9% in the fourth quarter of 2019-20. As the horizon was brightening up, escalating geopolitical tensions have cast a shadow on our economic outlook. Although India's direct trade exposure to the countries at the epicenter of the conflict is limited, the war could potentially impede the economic recovery through elevated commodity prices and global spillover channels. Further, financial market volatility induced by monetary policy normalization in advanced economies, renewed COVID-19 infections in some major countries with augmented supply-side disruptions and protracted shortages of critical inputs such as semiconductors and chips pose downside risks to the growth outlook. Taking all these into consideration, all these factors that I have just explained in the previous 5 to 6 minutes, taking all these into consideration, real GDP growth for the year 2022-23, that is the current financial year 22-23, is now projected at 7.2%. I repeat, 7.2%, with Q1 22-23 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, assuming crude oil, that is Indian basket, at $100 per barrel during the year 2022-23. Let me now turn to inflation. In February 2022 meeting of the MPC, we had projected a moderating path of inflation during 22-23. Heightened geopolitical tensions since end February have, however, upended the earlier narrative and considerably clouded the inflation outlook for the year. On the food price front, a likely record Rabi harvest would help to keep domestic prices of cereals and pulses in check. Global factors such as loss of wheat supply from the Black Sea region and the unprecedented high international prices of wheat could, however, put a floor under domestic prices of wheat. Edible oil price pressures are likely to remain elevated in the near term due to export restrictions by key producers as well as loss of supply from the Black Sea region. Feed cost pressures could continue due to global supply shortages, which could also have a spillover impact on poultry, milk, and dairy product prices. Coming to non-food items, the spike in international crude oil prices since end February poses substantial upside risk to inflation through both direct and indirect effects. Sharp increase in domestic pump prices could trigger broad-based second-round price pressures.